Welcome back to day 2. So yesterday, we laid our foundation. Today, we're going to build on that by pulling back the curtain on the stock market itself. For a lot of people, just hearing that phrase brings on a little bit of anxiety. Our goal today is to replace that feeling with a calm, disciplined understanding of what the market really is. Let's get into it.
And this, right here, is exactly where that anxiety comes from. For most people starting out, this is the feeling that you're walking into this giant, chaotic casino where lights are flashing, numbers are flying, and fortunes are won or lost on a random whim. It's a totally understandable way to feel, but it's also the very first illusion we have to break down.
So let's try a complete reframe. I want you to stop thinking of the market as a casino and start thinking of it as, well, a really big digital grocery store. Seriously. Once you strip away all the noise and the hype, it's just a place, a very organized place where ownership of businesses changes hands. You've got buyers, you've got sellers, and you've got products on the shelves. It's all about transactions, not a game of chance.
Okay, so if the market is a store, we have to understand the product that's actually being sold on the shelves, right? And that brings us to the most basic, fundamental building block of it all, the share.
A share, or a stock, you'll hear those terms used interchangeably, is exactly what it sounds like. It's a tiny, fractional piece of ownership in a real, living, breathing company. This isn't some abstract concept or a betting chip. It is a legitimate legal claim on a piece of a business.
And what does that little slice of ownership actually get you? Well, when you buy a share, you own a tiny fraction of everything that company has. We're talking about their real estate, their office buildings, their secret formulas and patents, and this is the big one. You have a claim on their future profits. And this leads to a really powerful shift in your mindset. The moment you buy even one share, you stop being just a customer, a consumer of their products. You become a part owner. You are now invested in the success of the business itself. And that's a whole different way of looking at things.
So, we know what we're buying, but how does the actual buying and selling happen in a place like the New York Stock Exchange? It can seem incredibly complicated, but I promise you, it's built on a type of transaction you've probably already done yourself.
Let's imagine for a second you want to sell your old iPad Air 6 online. The process is pretty simple, right? First, you decide what you want for it. That's your asking price. Then a buyer sees your listing and they make you an offer. Maybe you go back and forth a little, but eventually you both agree on a final price. Money changes hands, the iPad gets shipped, the deal is done. Now, believe it or not, the stock market works on that exact same principle. A stock exchange is really just a huge, incredibly secure, and super fast platform for that same kind of negotiation. You have sellers who have an asking price, you have buyers who have an offering price, and the exchange is the middleman that connects them in fractions of a second to make the deal happen.
And this whole system has a name. It's called a secondary market. All that means is that when you go to buy a stock, you're usually not buying it directly from the company itself. You're buying it from another investor, another person just like you, who has decided that it's their time to sell. It's just like selling that used iPad from one person to another.
Okay, this all sounds very logical and, well, kind of calm, doesn't it? So that begs the biggest question of all. If it's just buyers and sellers agreeing on a price, why does it feel so chaotic? Why do those prices seem to jump around every single second of the day?
The answer to that question lies in the most basic, fundamental law of all economics. It's a principle that sets the price for literally everything, from that iPad to a gallon of milk to a share of a company. And that is, of course, supply and demand.
It's really pretty straightforward when you think about it. If a company announces some amazing, revolutionary new product, what happens? Demand for their stock can shoot through the roof. Suddenly, you have way more buyers than sellers. And when that happens, the people who are selling can start asking for a higher price, and the price goes up. On the flip side, what if a company reports a huge, unexpected loss? Well, demand can just dry up. Now you might have more sellers than buyers, and those sellers have to lower their asking price to attract anyone, to make a deal. And so, the price goes down.
So that blinking number you see on a news channel or a finance app, the stock price, it's not some random, magical number. It is simply a historical fact. It's the precise price where the last transaction happened, the exact point where the most recent buyer and the most recent seller shook hands and made a deal. That's all it is.
All right, so when we put all this together, the grocery store, the share as a piece of a business, the iPad transaction, and supply and demand, we can start to build a new, much more disciplined mindset. So let's turn this understanding into an actual, actionable plan for today.
Here is your mental exercise for today. The next time you see a stock chart with its jagged lines going up and down, I want you to make a conscious effort to stop seeing it as bouncing numbers. Instead, force yourself to visualize what's really happening behind that line. It's millions of people all over the world buying and selling slices of ownership in real businesses based on what they think that business is worth.
And that's it. You've now demystified the machine. You know how it works. Tomorrow, we're going to dig into the two main ways that owning these businesses can actually make you money, something called growth and something called dividends. The foundation is now set. Stay disciplined.